Welcome to our channel, where we provide valuable insights and expert advice on finance and economics to help you become rich. In today's video, we'll be discussing the dangers of printing unlimited money and why it's not the solution to your financial problems. You might thinking that having an endless supply of money would solve all of your financial problems, but the reality is far more complex. In this video, we'll explore the law of supply and demand, the risk of hyperinflation, interest rates, and economic growth, role of money in the economy, and the role of central banks in managing the money supply. By the end of this video, you'll have a better understanding of why printing unlimited money is a bad idea and what can be done to address financial challenges in a more sustainable way. Number 1. The law of supply and demand. In economics, the supply and demand states that the amount of a product or service that is available for sale and the desire of buyers for that product or service will determine its price. Consider the following scenario. Suppose there are only a few apples available at the apple shop. This means that the supply of apples is limited. However, if many people want to buy apples, the demand for apples becomes high. In this case, the shopkeeper can raise the price of the apple because there are more people wanting to buy it than there are apples available. On the other hand, if there are a lot of apples in the store, but no one wants to buy them, the supply of apples becomes high and the demand is low. In this case, the shopkeeper may reduce the price of apples in order to attract more customers. This law applies to money as well. If there is too much money in circulation, it will decrease the value, because there will be more money competing for the same goods and services. For example, if the government were to print an unlimited amount of money, the value of each individual dollar would decrease, because there would be more dollars in circulation. This would lead to inflation, which is when prices for goods and services rise, because there is more money in circulation. Number 2. The risk of hyperinflation. Hyperinflation is a situation in which prices for goods and services increase rapidly and out of control. This can happen when the government prints an excessive amount of money, causing the value of the currency to decrease. As a result, people lose confidence in the currency and are less likely to use it to make transactions. This can lead to economic instability and can even cause the collapse of the government. One of the most famous examples of hyperinflation occurred in Germany after World War I is that the German government printed an excessive amount of money to pay for the war and other expenses, which led to hyperinflation. By 1923, the value of the German mark had crashed, and prices were rising so rapidly that people were using wheelbarrows of money to buy basic necessities. This economic crisis ultimately led to political instability and the collapse of the German government. Number 3. The interest rates and economic growth. When a government prints a large amount of money, it can lead to an increase in the money supply. This can cause the value of the currency to decrease, making it less valuable. As a result, the cost of borrowing money can increase, leading to higher interest rates. For example, let's say the government prints a large amount of money to stimulate the economy. This might initially boost economic activity, but it can also lead to an increase in the cost of borrowing. Businesses and individuals who want to take out loans to invest in new projects or make large purchases might find that they have to pay higher interest rates. This can make it more difficult for them to borrow money and can slow down overall economic activity. Furthermore, higher interest rates can lead to a decline in the value of stocks and other assets, which can further reduce economic growth. Overall, printing too much money can have serious consequences for the economy, including higher interest rates and slower economic growth. Number 4. The role of money in the economy. Money plays a crucial role in the economy by serving as a medium of exchange for goods and services. When the value of money is stable, people are more likely to use it to make transactions, which helps to facilitate economic activity. For example, in a stable economy, people are confident in the value of their money and are willing to use it to buy goods and services. This helps to keep the economy moving and allows businesses to thrive. On the other hand, if the value of money is unstable, people may be less likely to use it, which can lead to economic decline. Number 5. The importance of monetary policy. Monetary policy is the process by which governments and central banks use tools, such as interest rates and money supply, to manage the economy. This can help to promote economic growth and stability by keeping inflation in check and ensuring that money has a consistent value. Example: central banks use monetary policy to influence the amount of money in circulation and the interest rate at which commercial banks can borrow money. This can help to manage inflation and ensures that the economy remains stable. For example, if the economy is growing too quickly, the central bank may raise interest rates to slow down borrowing and prevent inflation. Number 6. The consequences of printing unlimited money. Printing unlimited money can have severe consequences for an economy. In addition to causing inflation and potentially leading to hyperinflation, it can also lead to a loss of confidence in the currency, which can cause people to stop using it. This can result in economic instability and can even lead to the collapse of the government. For example, in Zimbabwe, the government printed an excessive amount of money to pay for its expenses, which led to hyperinflation and a collapse of the economy. On 12 April 2009, the Zimbabwean dollar was officially abandoned as the country's currency due to its extreme depreciation. Overall, while governments have the ability to print unlimited amounts of money, doing so can have serious consequences for an economy. Therefore, most governments and central banks work together to carefully manage the money supply and maintain stable prices through the use of monetary policy. Thank you for watching, and be sure to subscribe and check out our other videos for more insights on economics and finances.